given the FOMC policy decision expected tomorrow and the additional expectation, or we might say the additional fear, that the FOMC might hint or actually begin to taper their bond buying program, makes this discussion of monetary policy all the more important. In my opinion, monetary policy comprises two different sections of our government, the first being the U.S. Treasury, and then, in addition, the Federal Reserve. We're going to talk about both of those, and in doing so, formulate an observation based on monetary policy that defines the injected liquidity into the U.S. economy. All of the information that you are about to see comes from the U.S. Treasury. You can find it in the Resource Center, and specifically, I'm using their second quarter report and the graphs that are contained in that report. Now, I know that economic discussions can be a little boring, so this is my way of adding some levity to our discussion. When it comes to stimulus, stimulus can take on two different forms. The first being a pure capital infusion into the economy, but the second influences the velocity of money within our economy. These do not always go hand in hand. In fact, right now, given the massive amounts of infusion that have happened over the past few years and that are still happening today, the velocity of money is barely moving at all. The velocity of money influences inflation, and it's moving at a snail's pace. And that tells us something. That tells us that the main influence our current stimulus program and the programs that have been in place for a few years now is to infuse capital. That's what they're doing. They are not actually influencing the velocity of money. So it is the infusion of capital, the infusion of liquidity, that we should be focused on. Monetary policy is all about the actions of the U.S. Treasury and the Federal Reserve, but it also has everything to do with the budget deficit. If we have a continued deficit, we are going to need to issue more and more bonds. And although we are doing better, and we are projected to continue to do better at controlling our deficit, deficit levels are still expected to be quite high. These are not surpluses, these are deficits, and they need to be funded. And there are two ways of doing that. Higher taxes, of course, is one way, and issuing debt is another. However, it is not just new debt that we need to take into account. We also have to consider maturing debt. And given this side of the ledger in this chart, we can see that during the first 3 quarters of the government's fiscal year, it has issued $792 billion more in U.S. Treasury bonds. So it is issuing more bonds than it is refunding. And when it does that, it drains money from the system. It takes money out of the economy and puts it into the hands of the government. When the government issues bonds, it takes money out of our economy. And that's a drain on liquidity. We could do the math ourselves, but the Treasury has graciously already told us what it expects borrowing needs to be in 2013. It also does that for future years as well. However, our focus is on monetary policy today and how changes in monetary policy will affect liquidity today. So, this $1.1 trillion level, that's the one we'll focus on. The formula for identifying net stimulus is to calculate issuance, subtract refunding, and then add in the FOMC bond buying program. And then, to identify the net stimulus domestically, we need to adjust for foreign interest in U.S. Treasury bonds. And so I've done that. Again, graciously supplied by the U.S. Treasury, this bar chart represents foreign interest at U.S. Treasury auctions. And as we can see, foreign interest has been declining steadily. And in fact, for the past few quarters, it has been under 15%. That gives us a variable that we can apply when adjusting for domestic stimulus. Therefore, the formula for net domestic stimulus equals 85%, this is the variable that adjusts for foreign interest, times the net monthly stimulus after Treasury issuance and refunding. This is extrapolated from what the U.S. Treasury expects to need to borrow in 2013, plus the efforts of the Federal Reserve. This equation identifies the net domestic monthly stimulus, the net domestic capital infusions into the U.S. economy. The result is about $6 billion in net domestic stimulus per month. This includes operations of the U.S. Treasury and FOMC policy decisions. The combined effort adds liquidity, infuses capital into the U.S. economy at a rate of about $6 billion per month. However, and this is where the concern comes from, if the FOMC were to change its policy from infusing $85 billion a month into the system, it would run the risk of turning monetary policy from a net stimulative to a drain on liquidity. This would happen if the Federal Reserve merely decided to taper by $6 billion, which would put it at $79 billion per month. If they did any more than that, the combined effort that makes up monetary policy would cause monetary policy to be a drain on liquidity and a headwind to economic activity. Even if the Federal Reserve were infusing $45 billion, let's say, it would still be a net negative. It would still be a drain on liquidity because the face value of this program is not actual stimulus. The U.S. Treasury is draining liquidity from the system at a much faster rate. and any tapering by the Federal Reserve can therefore have drastic effects. I do not know if the FOMC will begin to taper its program at this coming meeting, but I do know that when they started this, they anticipated it to last no more than a year. I also know that in many ways, the stock market has been reacting to this constant stimulus, presupposing that the Federal Reserve would continue to infuse money and continue to support the economy and asset prices as a result. As I have shown, even a slight reduction in this program can cause the net stimulus that has seemed to drive the stock market to turn into a drain on liquidity instead. That puts us between a rock and a hard place, I'd say. And it increases risks substantially. So I'd watch out. Because if they do begin to taper, which is inevitable based on the expectations when they initiated the program, the changes in liquidity could have a substantial ripple effect. Remember, on the other side of the ledger, fiscal policy is already tightening. Taxes are already going up. And if we have a drain on liquidity, that could be devastating to our economy.